Mobile money, the market structure is super interesting. It's a platform to do really good economics, studying questions within the marketplace when it comes to financial services for the poor.
Welcome to part one of a two-part VoxDevTalks special. My name is Tim Phillips. How can we design digital financial inclusion in a way that minimizes fraud and maximizes the benefits of the community in rural, low-trust or cash-heavy economies? That's the question posed by 3 studies from Ghana, and the author of those 3 studies, Francis Annan of Berkeley. I spoke to Francis twice about this research recently. It's been a big part of his working life since he was a graduate student. Today, we talk about his innovative interventions to minimize fraud and misconduct in the mobile money market. In the second part, coming later this week, we will focus on how he managed the relationship with providers and regulators that has allowed him to build on the impact of this work. But first, I asked Francis why mobile money is so fundamental to development. Francis, welcome to VoxDevTalks.
Hello, Tim.
These studies, all of them, are about the day-to-day mobile money market in Ghana. Explain to me why mobile money is so important, so useful in Ghana, especially in a rural village setting.
Mobile money, obviously, it's about access to finance. It's really about improving the financial lives of people, especially the poor. At the same time, we have a lot of evidence, in particular in economics, that have shown it has the ability to lift people out of poverty. It has the ability to improve welfare, the ability to save, the ability to empower people distinctively, the ability to remit money in a low-cost way, the ability to mitigate shocks that are very profound in a lot of these settings. And the list goes on and on and on. It has the ability to build the financial and economic resilience of people in this market. Ghana is not an exception. In as much as mobile money is part of the day-to-day life of people in Ghana, it has this profound ability to actually improve welfare.
You describe the people who are providing these services locally as human ATMs. Can you describe who a human ATM is?
For lack of a better definition, I like to think of these downstream players that actually interface with consumers as human ATMs. In the classic formal financial service institutions in the US and Europe and other places, either we interface at the banking hall, we go to an ATM to make deposits or withdrawals. There's an analog of that when it comes to mobile money as a medium to provide access to finance. And the markets are in principle organized such that we have upstream players, in this case, large commercial providers, telecommunication companies, and some back-end commercial banks that are actually delivering this service. But how do you make these services accessible to people in places where these banks are not located? Well, you're going to need this human ATM on behalf of this upstream player who offer the ability for consumers to show up, open new mobile money accounts, make deposits, what people call cash-ins, make withdrawals, what people call cash-outs, and onboard a bunch of other digital tools at these retail outlets. So human ATMs are going to be these downstream players that act on behalf of these large commercial providers of mobile money that actually interface with consumers to deliver this massive space of digital tools.
For this system to work well, what sort of infrastructure do we need? And also what kind of human relationships, trust relationships that we need for markets to function? What do we need to be in place?
This is about technology. So we need to have access for connectivity. That's one thing which is very structural. And I think one of the key things that makes mobile money appealing, especially in these markets, is how telecommunication infrastructure has scaled quite profoundly, right? From the city to the village. Clearly, you're going to need the connectivity. At the same time, this is going to be about humans. So we're going to move away from technology and now begin to think of human interactions, where consumers engage with this human ATM at some point. So then the notion of trust and accountability becomes very important. For you to sustain and maximize the impact of this technologically driven financial service, you're going to need a trustworthy and more accountable financial marketplace, which unfortunately has not been the case, especially in markets like the village, the poor, where Historically, people have lacked access to formal financial services. And at the same time, these people are also very vulnerable, right, to begin with.
Yeah.
Having to now transition from informal finance to more formal finance creates a lot of vulnerability. And this is a marketplace that could deliver a lot of risks. Of course, it also depends on the beliefs that people have in this market economy. And in fact, if people have the wrong beliefs about the risks that this market poses, then clearly this is going to undermine trust. Commerce only thrives on trust. At the same time, of course, we're going to have to rely on accountability mechanisms, right? Really, how do we monitor? How do we provide redress mechanisms for people in this space? In advanced economies, when it comes to finance, we have seen a lot of regulatory power and very interesting redress mechanisms that consumers, as and when you're victimized, right, you could report and seek for redress. It is less so in this context, these environments where these institutions are shallow and don't function as well. At the same time, we're talking of a single village who lives somewhere in the corner of northern Ghana or northern Kenya. It's going to be hard for even a regulator, right, to show up in the village and say, look, I'm going to go look at this. So you're going to have to think of really local policies or local regulation for local problems.
We're going to discuss these 3 papers, which are about how those risks can undermine trust and how they can make these markets not work well in some cases. First of all, we're looking at overcharging by vendors. The human ATMs, they charge for their services. Who sets the tariffs that they are allowed to charge?
Markets for mobile money are designed to be vertical in the sense that there's this upstream commercial player who owns the platform and provides a service, call them providers. And then you also have these downstream intermediaries, call them agents or vendors. And these are supposed to act on behalf of the provider. The tariffs or the fees on transactions and services that are delivered at these retail points, ex ante, set by the upstream player, in this case, the commercial provider. And the human ATMs are supposed to take these prices as given. Prices, by definition or by construct, are designed and set by the commercial provider. So it's basically a volumes market. The more transactions you do, the more commissions you earn. And we can talk quite at length about why this is a good or bad policy, but I'll leave that for another podcast.
In this case, you're investigating overcharging. How widespread is this overcharging and how do they get away with it?
Across different markets, different districts, different regions, it's almost like a magic number. It's remarkably widespread. 1 in 4, 1 in 5 transactions are overcharged.
Wow.
Especially in the villages. And this is very consistent. And by the way, this also has a lot of external validity. There are all these cross-country surveys from Nigeria to Uganda and all of that, which have been run by our sister institution like IPA, where in fact consumers report similar levels, if not even higher levels of overcharging. So it's a phenomenon that's really, it's part of this market that really limits the ability for us to maximize the impact. There are a lot of channels through which these human ATMs can get away with it. In a lot of instances, consumers are not even aware that they're being victimized for the first time.
Right.
Because consumers have poor visibility into what the true prices are. And there's limited price transparency. For you to become a human ATM, you are trained for this commercial provider. But unfortunately, consumers are never trained to become consumers. So that creates this massive asymmetric information or knowledge gaps, if you want to call it. So as a consumer, you're going to have to learn it the hard way. You're going to have to get victimized at some point. The other part is also the fact that you may not be information. Indeed, you know that you're being victimized, you're being cheated, but you don't have an option. The only guy who offers the services says, look, this is the fee, and especially when the redress mechanisms are very weak. So the only way you might respond is, well, I'm going to use it very less, maybe not more, but I'm taking into cognizance of the fact that I may be cheated. This is not. Regulation and monitoring is very weak. Cost of lack of compliance in the marketplace is so very low. Retailers or agents, these small firms, might take that into consideration as they do the mental calculation, right, of whether to cheat or not. The costs are low, the benefits are high. The other reasons, imagine that even when there are more players, there are more retailers in the market, and one person starts cheating, it destroys the market capital because now no one else believes in the market, and therefore everyone follows suit. So then you run into this prisoner's dilemma problem, where in fact the market can sustain a very bad outcome, where just one lemon in the market could actually make the market a lemon market, because people have beliefs or lack of trust about the service, not about a particular provider, right? Downstream, and therefore you are better off also cheating, even if you don't want to cheat. We have a lot of evidence of that.
You used an experiment to see if we could reduce the level of cheating, the level of misconduct. What did you do?
We spoke about information asymmetry, right, between the downstream providers and also consumers. So you imagine interventions that are information related, thinking how to reduce misconduct by eliminating those informational frictions that prevails between the vendors and also consumers. Okay, so that was the starting point in thinking about this. All the other projects are going to take these different frictions one by one and try to relax them to see how that matters in resolving this misconduct. Really thinking hard about the structure of information that we can provide to consumers, but not in fact to only consumers, but also to the providers, what I call two-sided information interventions. We want consumers to have access to this information. At the same time, we want the agents, the suppliers, to also know the consumer has access to this information, and here is that information. And there's a precise thing that we know about these village economies, the notion of reputation, which matters a lot. You really want to design information interventions that turns on this reputational channel in a way that can allow us harness the value of how these local institutions are organized. In short, these were two-sided information programs where consumers were better calibrated about what the true prices are, and the agents, suppliers, also made aware of the fact that now consumers are aware, of these interventions. Very simple, very low-cost information programs that has the ability to distinctively reduce misconduct.
So in your treatment, the consumers knew how much it should cost. The vendors knew that the consumers knew. Did it work? Did this reduce the level of misconduct? And also, did it make the consumers more confident that they were not going to get cheated?
Yeah, so a lot of things happened. Number one, if you take two villages, in one village, you introduce this two-sided information intervention. In another village, don't, and presumably these villages are identical. What you see is that agents in treated villages are about 72% less likely to cheat. So indeed, it did a lot of change to the incidence of misconduct. In not just incidents, but even on the severity of how much is overcharged. So all of that changed remarkably. Of course, before the interventions were rolled out, one of the key facts about these markets is that consumers were poorly informed or even calibrated, not only about what the true prices are, but in fact, what the true level of overcharging is in the market economy. In fact, if you do objective measures of overcharging or agent misconduct, you estimate around, let's say, 20 to 25%. Okay, as I explained, 1 in 5 or 1 in 4. Objective. When you ask the consumer, what do you think, is the prevailing level of misconduct? He tells you 60% of the time. So clearly, consumers are even... So once you provide this information, you do not only reduce the level of misconduct because people care only about reputation and cutting down on overcharging, right? But you also actually make consumers better calibrated. So in fact, the risk is not as we think as it is. And these beliefs are very useful, right? Because they may have imperfect beliefs, right, about the level of misconduct. But in fact, all their market decisions are based on that. So getting consumers better calibrated is one thing. But conditional on giving that information, agents or firms responding to this information is also another thing. So you see that eventually the treatment effects that we estimate, the effect of these information interventions that we estimate, is going to be a decomposition of two things. One is about eliminating the bias in how much indeed there was, and then also the fact that now providers are responding to this information program because of what the reputation they care. And indeed, we saw massive improvement in demand for these mobile money services across our treatment and control villages. And a lot of this is driven by both the fact that the behavior of the retailers are changing, but also the bias from the consumer side is also changing.
Do you have to tell every person who's using mobile money about this? Do you have to educate everyone? Do you then have to inform all the agents as well? Or can you do it for some of them and there'll be a spillover effect because the agents become more honest and people talk about it?
In fact, you're ahead of my paper, but I like that. And that's precisely what we did. We were in the search for what we call low-cost information interventions. Obviously, one of the biggest questions in development is how do we achieve the same impact at a lower cost? So in that sense, we toyed ourselves with this idea of externalities or spillovers, which actually simply meant that I didn't have to talk to all agents or all consumers in the market for this to work. The way the markets are organized, a typical village in our setting has roughly about 3 agents. 3 providers, the typical village. This is with a population of about 500 to, let's say, 5,000. What we did was that to do a census of these markets, and then we only randomly treated some agents or some providers and not all. So that even in the treatment village, we can study the effect of how the non-treated firms responded to the intervention conditional on any of the other competitors or other firms in the market being treated. And it didn't really find a lot of large effects. The untreated firms responded close to half of how the treated firms responded. They had the ability to provide some template in thinking about how to deploy these interventions at a low cost precisely because you don't need to talk to everyone for them to work.
To your second paper, because you did mention that one of the reasons why there is misconduct is because people don't really have many alternatives. They go to the agent, and if the agent overcharges them, well, that's tough. They don't have a choice. So your next study, this focused on what happens when we recruit new vendors. At the outset of this, if I recall correctly, there was a ban on recruiting new vendors. Is that correct? Why was that?
That is exactly correct. When you have only one provider in the market, you could actually create incentives for overcharging to prevail.
Sure.
And that may be very orthogonal or independent of the information structure we described in the previous paper. It is also very true that when even you have multiple providers and they all collude to do the same thing, you could still end up sustaining misconduct, overcharging in the marketplace. From the previous study, if you look at the data, there was one thing that was very predictive of misconduct. If the provider is involved not only in providing these financial services, but also doing other non-financial services, they are less likely to overcharge. The fact that the guy sells rice and also provides financial services is less likely to commit misconduct. That for me was a trigger in thinking a little bit about maybe there's something to be done about whether people specialize in service provision or people bundle in service provision, and how, to what extent that matters in understanding the structure of misconduct in this market. We can discipline the market to some extent. It really depends on whether people specialize or do not specialize or bundle. One of the biggest motivations for this paper is that if you look across the world globally, how a lot of financial markets have evolved, in principle, is to pursue this low-cost way of providing services. We've seen Wells Fargo closing out their branches in the US and actually looking for retail outlets or maybe some supermarkets to actually now begin to offer services within the supermarket. So in some sense, the traditional approach in scaling financial services at a low cost from developed to developing countries is really this idea of really interlinking financial to non-financial service. You would even imagine, you ask yourself, where are typically the ATMs located? Typically, they are in some restaurants, they are in some stores, right? People show up not only to buy, some grocery, but also take money at the same time. And it turns out the same revolution is happening in the way mobile money markets are organized. The modern approach in scaling mobile money is really about finding a corner store and convincing this corner store, encouraging the corner store to then interlink financial with the non-financial stuff, which is the core business. So this has the ability to change the structure of misconduct in the mobile money market. There was a ban. It's both a blessing and a curse, because ban probably meant that we couldn't have more providers. And so if more providers meant that misconduct is going to be lower, then actually it's bad, right, for consumers. But it's also good because we can carefully take a step back and ask ourselves, maybe there's something to be done here to learn more about randomized entry into the marketplace. So it's good for research, but maybe bad for consumers before the start of the product. The market had evolved to some point where, first of all, providers were unsure about what the optimal number of agents to have in the marketplace is. How many branches should I have in a village? I don't know. They're going to have to try, okay? They're going to have to keep going, keep recruiting up until they get to the point where they think, oh, well, the market is too saturated because of ABCD. Go to the point where they were not sure about what's the optimal level of agents I should have in a village. It all depends on a bunch of things. But the market has evolved to the point where there was a black market that was evolving, where people get the license to become an agent and they sell the licenses at a higher price to other people. So for them, that was a clear signal. No, something is really happening here. Of course, combined with the fact that there were these issues that were coming up regarding misconduct, and even in some instances, some of the agents being inactive, precisely because of this black market activity. So for them, it was a clear signal that they need to take a step back and reevaluate their entire agent network to ask the question, are we at the optimal point or we are not? And if we are not, what do we have to do to ensure that we can keep going, but also to help fix the issues that we have identified? So there was a pause in recruiting or providing licenses precisely because of some of these signals that the provider was worried about. So I went in and said, well, maybe we can do something here. Let's think a little bit more about what it means to redo what you have been doing in a more randomized way. And that led to my conversation with the CEO. And he was like, well, in fact, we actually have been talking at a corporate level that we wanted to actually scale our presence in other markets. So I said, okay, then wait, let's do this together. Give me the list of markets or villages Now, you and I can work together in actually scaling this, and that's gave birth to this particular project.
You managed to convince them to recruit some new vendors into the market to see what then happened to those markets. Is that correct?
That is exactly correct. And not just recruit new vendors, but to randomize the saturation of how many vendors we can have across the market so that we can trace out the equilibrium effects of this new entry.
And so in equilibrium, when you got these new vendors on board, did it have an effect on misconduct? Did it have an effect on the amount of business they were doing?
Well, a lot of things happened, but let me tell you two of the major ones. One is something happened in the financial market, the market for mobile money. Incumbent mobile money vendors were less likely to commit misconduct, to cheat. If the market got a new entrant, who is now this new corner store that has randomly been onboarded. So actually, there was some pressure on incumbents to promote consumer protection practices in the marketplace. So that's on the mobile money side. On the non-financial side, which is, again, this is where we interlink those non-financial stores now to become mobile money agents. We saw large increases in the revenues for the non-financial staff, which is very interesting. And I think it's really this story that mobile money markets do not only have the ability to build financial resilience, which is more along the lines of improving the lives of consumers and households, but I think this is a result that shows the spillover effects on the non-financial markets that traditionally we don't think of financial markets have. So we saw large impact on the mobile money market, more so on things that relates to misconduct and consumer protection. We also saw much improvement in business outcomes and some aggregate local economy effect on the non-financial services, which I think is super distinct in the way that we like to think of markets for mobile money.
You were saying that you'd identified that agents that had a non-financial business already were less likely to be involved in misconduct. Could you explain why that is? Is it because reputation is more important to them in that area as well, or is it something else?
The story is a bit more nuanced, but there are a couple of hypotheses. One, obviously, is, as you described, they came about their reputation. Because once you get hit, right, in the market, you don't only suffer in your services for mobile money, but you also suffer in your services for rice, if rice is what you sell. Yeah. So in that sense, the reputational impacts are likely to be much larger there. So that's one hypothesis. The other hypothesis is related to the fact that, of course, these firms are very smart. The main line of business for you as a bundle store is you sell rice. That's what you care about. In rice, there's no regulation in prices. You could actually set higher prices for rice. So why cheat? You could imagine reducing your prices for mobile money by increasing your prices for rice. Overall, you keep higher profits. We see a lot of that in this paper. Prices for entrants for the rice went up a little bit. They were less likely to cheat. To see this pass through from the financial to the non-financial market.
So let's look at your third study in this fascinating collection of research where you're looking at the effect of gender on misconduct. My first thought about this is, how can you identify the effect of gender, either from the point of view of how do you identify which transactions are being done between women, between men and women, and between men, and also identify that if there is any misconduct in the transaction, it is gender that is causing it?
Of course, the general premise, we have been talking about the notion of misconduct in the marketplace. We know very little about the nature of misconduct in this market. And gender seems to be one of the key things that could be at play here. Because obviously, in economy, in theory, we have a lot of theories suggesting gender differences in attitudes towards risk. Aversion may be gendered. Sophistication could be gendered. Competition responses might be gendered, and a bunch of other things. So there are a lot of really, in theory, differences in these market-based primitives that actually could help us think more conceivably about why misconduct could be gendered as well. Also imagine that in a marketplace like these villages, if misconduct is committed disproportionately against one particular gender group, then that could be discriminatory. And not just discriminatory, but it could also be inefficient, especially if misconduct reallocates resources from the more efficient gender to the less efficient gender. And you can imagine that it could be even efficient because it just increases the marginal cost of transactions. And this could lead into some of the issues that we discussed in the earlier paper, where people actually think that the risks are higher than they are in practice. So again, the notion of how gender interacts with misconduct is something that is both theoretically and empirically rationalized in the context that we're thinking about. What we do is to propose this non-standard audit study where we recruit auditors, call them their consumers. These are consumers that lives in this market. a bunch of them. And given that we have a census of all these agents by gender, so for each agent, we have a census. We know the gender of the operator, the owner of the store, and everything. Now, of course, because we recruit our consumers to send them at random to go to places, right, and conduct transactions. And they are trained and calibrated in a way that right after every transaction, actually they record the experience of the transaction in a tablet that is usually in their backpack once they leave the premises of the agent. That allows us to overcome some of the massive data constraints that we have, especially if you want to think of misconduct and gender, but also in a way that actually allows us to say something about sorting. In the traditional marketplace, people may sort. You decide where to go to. But in the way our experiment is designed, actually, we randomly assign people. You don't decide where you go, but we assign you to places where you go. So you can really measure the true effect of different consumers being faced with different things, different misconduct responses by gender.
Were the female, I suppose we could call them secret shoppers, were they cheated more often?
Yeah, and this is probably not an unsurprising result. We've seen that in other markets, shopping for housing, shopping for automobile, like a car, or you've seen a lot of that. So female auditors were massively discriminated against. They were much more likely to be cheated in several magnitudes relative to their male consumer counterpart. And this is very massive. And the cheating is more so when female customers visit a female vendor.
What?
Compared to female customer visiting a male gender.
No way.
See this evidence of within gender discrimination for females, but within gender favoritism for males. In other words, if you were to send a male customer to go out there and engage in this mobile money transaction, of course, everyone is being cheated, but female consumers are being cheated more. Okay, that's the first fact. So there's really purely discrimination by gender. Beside that, female customers were victimized more if they had visited a female vendor compared to if they had visited a male vendor. You see this very complicated gender dynamics, not only about discrimination by gender on the consumer side, but this within gender discrimination, more so on females, but also within gender favoritism, some version of that for male to male matches. The result is that we see a lot of what I call gender misconduct gap. The fact that female vendors were more likely to commit this misconduct.
This goes so much against my prior belief.
Yeah, most of the people in the market are going to tell you we think male vendors are literally going to commit more misconduct than female vendors. We find very different results, that there was this massive gender misconduct gap. There was this gender discrimination where female customers were more likely to be cheated. And you see this evidence of within gender discrimination for females, but also within gender favoritism for males.
Can you explain why this is happening, Francis?
3 hypotheses or 3 potential explanations. One is more about beliefs and misbeliefs in the marketplace. In fact, when you ask the market, as I explained before, everyone thinks that male vendors are going to be non-compliant compared to female vendors. This is the conventional wisdom in the market. Imagine that you're that female vendor and you know the market is poorly calibrated about your true behavior. What will you do? You do it more. Right? Well,
yes.
We have some evidence that is very consistent with the fact that beliefs about the fact that the market underperceived the true level of misconduct by female vendors is one explanation for why. For example, you may see the female misconduct gap.
Of course, yeah.
To why this discrimination by gender against females. The results are mostly particularly driven by villages where there's low female empowerment. There are standard measures of measuring female empowerment, and we see exactly that. The fact that if you're a female customer, you live in a village where females are not empowered, there's a lot of social distance between males and females, then those female consumers are likely to be victimized. The third story actually relates to gender differences in income. And we see this more so as one of the key drivers for why, again, we have that gender misconduct gap, which is the idea that if you're a female vendor, and because to begin with, incomes are low for females, or you live in households where incomes are low, then your dependency on this extra income that gets generated with the misconduct is much more so. So female vendors are more likely to be more dependent on the extra income from misconduct. And this is more so in villages where there are massive differences by income between gender. So I should have mentioned that almost everyone in the market believes that male customers are more sophisticated than female customers. Right. What that also implies that, of course, you want to do more victimization on female customers because they're less sophisticated. So the belief structure matters a lot. And we see this when we do follow-up surveys, really engaging with the people in the market. Okay, that's number one. Second part is about differences in empowerment, okay, by gender. And then the third one being the fact that there are these income differences that actually also rationalizes why female vendors, because they are more dependent on this extra income. There are a lot of conclusions here, right? You could imagine that the notion of social distance, either through beliefs, structure, through empowerment structure, or through even income, could act as an important source for misconduct in the market in this discriminatory way that we think can undermine the functioning of financial markets.
Francis, I think there's probably quite a lot more in the papers that we haven't had time to talk about today, but thank you very much for describing them to me.
Absolutely. And thank you too for asking. Mobile money, the market structure is super interesting. It's a platform to do really good economics, studying questions within the marketplace when it comes to financial services for the poor.
Those three papers we were discussing, Misconduct and Reputation Under Imperfect Information, that was published in the Journal of Political Economy 133, number 5, 2025. Randomized Entry, The Equilibrium Effects of Entry in Digital Financial Markets. And Gender and Financial Misconduct, a field experiment on mobile money. This has been a VoxDevTalk. The best way to make sure you don't miss an episode is to follow us or subscribe. You find us wherever you get your podcasts. Our past episodes, as always, are at voxdev.org, where you will find plenty of articles about topics like this one. If you like what you're hearing, then please tell someone else about us. And also, leave us a review. VoxDevTalks is a Talk Normal production. The assistant producer is Megan Bieber and our editor is Andrei Zargarian. Thanks to Oliver Haney and Iman Siddiq at VoxDev.